Good afternoon. Time to have a look at market news now. Major markets across Asia bounced back following losses the day before that were triggered by renewed uncertainty on the Omicron COVID variant. Hong Kong's Hang Seng Index also advanced, rising 0.7%. However, mainland Chinese stocks closed mixed. In Japan, the Nikkei closed 0.4% higher, a slight recovery following multiple sessions of losses. European stocks were higher after struggling to regain ground amid fears around, again, the Omicron COVID variant. U.S. stock futures were higher in early morning trading following a Wall Street sell-off over fears about the variant. And, of course, yesterday afternoon's Federal Reserve announcement mulling a quicker than planned taper. To talk to us about how all of these themes are playing out in our local markets, we are joined by Michael Treherne, who's from Vestec Asset Management. Michael, thank you so much for your time. The JSE earlier opened a little bit firmer. It was led by the banks, retailers, and then the financials. It's around 1:30 this afternoon. How are we looking right now?
Afternoon, Nastasia. Yes, JSE all share up about 2/3%. Green on the screen is what we like to see. After a slightly tough day yesterday, we're doing a lot better today, and it seems to be positive news about Omicron impacting on people. But it's still early days, and we need to see exactly what this variant looks like, and we'll probably only know that in the next 2 weeks. So expect a volatile market for the next 2 weeks while data comes out.
How are you digesting Fed Chair Jerome Powell's statements, especially, the expression that social media went mad on, retiring the word transitory?
Yes, so the market definitely had a negative reaction. It was a sell first, think about it later sort of scenario. The reason he wants to retire the word is because it's got many different meanings to different people. Basically, it's vague. So, transitory can be a couple of months, could be a couple of years, and depending on the context, could mean very different things. So he feels that it's too vague to be used. So he's going to try to find wording that's a lot more specific. Effectively, the Fed is saying, though, that they feel that inflation could potentially be a problem, but that the economy is looking strong enough that they can start raising rates sooner than expected, and that has resulted in the yield curve flattening.
So the other issue that has come to the fore again, and I suppose it comes into the news space every now and again whenever we read a headline in business publications around buyout offers when it comes to some of our locally listed companies, and then we see these articles about the increase of delistings on the JSE and the lack of new listings on the JSE. How much of that is a concern for you? And I suppose the next part of my question is that what do you think other companies are seeing from our companies locally that makes it so attractive for you to want to buy that particular company out and, take the shares off the market?
Yeah, so lots of different questions there, but I think the main issue that we're facing at the moment is the lack of new listings on the JSE. Delistings are a very normal part of the economic cycle and a stock exchange. That's not overly worrying, but the lack of new listings is definitely a worry. It's understandable. We've had basically zero economic growth since Nenegate in 2015. And without economic growth, you're not going to be seeing too many new companies coming through. You're going to see stale old companies keeping their ground with not much growth. So I think the lack of new listings is the worry because it points to underlying issues in the economy itself. In terms of the delistings, smaller companies, it's not always very efficient for them to be listed. In many cases, the smaller companies that are being delisted generally have a large majority shareholder, which makes the shares illiquid. And illiquid shares don't trade much, and they trade at deep discounts. So as an individual investor, where you want to buy a few shares here and there, it's not efficient. But if you're a large investor who wants to delist someone, you can swoop in and you can do a buyout offer, and that would make sense at a deep discount. So I think it's just the mechanics of how the market works with these small companies.
Right. I want to take the conversation a little bit back to the U.S. and talk about the U.S. Treasury yield. I mean, at this particular point, it doesn't seem to show, any imminent doom for the equity market in and of itself. But at what point will we start to see some kind of alarm bells? What would the curve be showing us in order for us to start seeing that there might be a problem in the system here?
Yeah, I think you'll see the problem only once it's arisen. In terms of the current market's expectations is that interest rates are going to rise quicker than expected in the short term, but long term the market's expectations haven't changed. The expectation is for lower inflation for longer. That means lower interest rates for longer. And the basis of that is we're seeing very strong technology growth, which makes our lives cheaper. And as long as you can keep a cap on inflation, then interest rates don't have to go up and equity markets stay at these current levels.
Right. So let's talk about the oil price for a little bit. I mean, a couple of days ago, probably say yesterday, I would say, when you looked at the price of Brent crude, struggling to nurse some of the deep wounds that were inflicted by what we saw on Friday on the back of this new Omicron COVID variant. When we look at news coming out this week, we are expecting some kind of news from OPEC. Is there any, indication that they can rescue those who might describe themselves as oil bulls, for lack of a better description?
I suppose it depends what level you need the oil price at. Oil's already much higher than people were expecting for this year. So I think OPEC nations are happy in general. It looks like they're going to stick to their path of increasing supply slowly. Maybe they'll slow it down just a touch. The big concern for oil-producing nations is that we have renewed global lockdowns, which means a lot less travel, which means less demand for oil. And that's why we saw the oil price struggling as we came into this week from last week. So I think the main thing is going to drive commodities and equities is new news about Omicron. If it's really, really bad, then we see global lockdowns. If the symptoms stay as it seems, that it's fairly mild but very contagious, then maybe the world doesn't lock down and things look like it looked like a week ago when we didn't know Omicron existed.
On the back of that, then, does that risk overshadowing Friday's jobs report numbers if, I suppose, between now and wherever our levels of fear is sitting at when it comes to the Omicron variant, is there a possibility that it may overshadow Friday's U.S. jobs report?
Yeah, I think there's no doubt that any new reliable news about Omicron research will be center stage for the market. Yesterday we had Moderna's CEO coming out saying that their vaccine isn't as effective against Omicron as they would like. So they're already working on a booster shot that specifically targets Omicron, and that sent the market down. It's any new news is going to be market moving news. I expect that to be the case at least for the next 2 to 3 weeks.
On that note, before I let you go, what else are you looking at on your screen? Key event.
This afternoon is the Fed releases their beige book, and that's a general update on economic activity in the US. It includes interviews with CEOs and production managers. So it's a nice high-level look at the US economy. So that's published 8 times a year, so it's always worth a read.
All right, Michael, thank you so much for your time. That is Michael Treherne, who's from Vestec Asset Management, giving us some analysis on what is happening on the markets front. We're going to take a quick break, and when we come back,